Hey guys, I get the question a lot about if people should be selling stocks right now. Right? We've seen stocks continue to hit all-time highs, doing very, very well, and I get it. Right? We've been in a super bull market, but I want to explain to you, and something I do for my subscribers as well, Curzio Research, is a very simple explanation of why stocks are going to continue to go higher, and they're going to go higher for a while before this thing eventually blows up, which I'd say a couple of years. But here's a simple answer in case a lot of people were wondering, which they are, and they're emailing me. So I'm going to share my screen like I normally do. Try to make this a really quick video. So this is research from Bank of America. It's just flows going into hedge funds and coming in, coming out. So this is a weekly report. So this is recent right there, April 21st. I want to share a couple of things. One is the amount of money coming into stocks. So this is the amount of money in the past 12 years, 452 billion that has come into stocks. This is the amount that's come into the market in just the past 5 months. I mean, that's incredible. Now, why so much money coming into the market? Well, yes, low interest rates and equities are better. It's hard to get yield. I mean, you're seeing it even here. Quick chart here. This is the past 12 years. Blue line is bonds, how much money is coming to bonds. And now you're seeing equities. Look how straight this is. And you're seeing a lot of money from bonds where it's very hard. And with interest rates, 10-year is going a little bit higher now. But still, equities offer a very, very favorable risk reward. Now, why is that happening? Why is so much money coming in? It's pretty simple. It really is. And this is really a great chart. So this is Bank of America break it down, fiscal monetary policy track, right? So it's fiscal stimulus, monetary stimulus, and they break it down by every single country. Look at these numbers for the U.S. This is the amount of fiscal and monetary stimulus that has been injected into the market already. This amounts to $10.5 trillion, nearly 50% of GDP. To put that in perspective, you look at Japan, which is the next largest. What do we have there? It's 3 times the amount the U.S. compared to Japan. That's how insane it is. So you're looking at a massive amount of money. Yes, the GDP numbers are high here with different countries. But when you look at the U.S., the amount of money coming into this, right? 50% of GDP has come in. So people have more money. Household wealth's going through the roof. This is absolutely amazing when I see something like this, because this doesn't even include the 2.3 trillion infrastructure bill that's expected, and we know only 10% is going to infrastructure. The rest, who knows where it's going. But you have to put this in context, because everybody was given this money. Never in history has this happened. They've all been given this money at the same exact time, hitting the bank accounts, and we've all had basic handcuffs on, telling us that we can't leave our houses. So people are dying to get out. They're dying to spend. That's why you're seeing inflation every place except for the CPI, which is all you should care about as an investor, because they don't really see inflation, but there's inflation everywhere. I mean, try buying lumber right now. Look where copper is, just tuition bills, everything. Everything's through the roof, and people are paying these prices because they have more money than ever. This is going to continue to fuel the market. They're handing free money to people at the same time. They have a ton of money to invest. All assets are being inflated. They're taking money out. They're borrowing more because interest rates remain low, even though they've gone up high. These are all very, very favorable conditions for stocks. Yes, they're expensive. It's not the easiest to find good ideas, but if you're long, and you should benefit, especially if you have some of our news of credit research, stay long. We'll see the writing on the wall when this thing's going to blow up, but it's not going to be for a while. As long as they keep handing checks and trillions of dollars here and there, you're going to see the market go a lot higher, and you're going to see probably the cyclicals benefit the most, because they're still down about 15-20% from the highs. Many of these names, right, especially travel-related stocks, that's what we're investing in our newsletters. But that's a simple reason. I'll bring it up once again, because I can't believe $10.5 trillion has been injected into this market, and also they've cut rates by 1.5% so far. Yes, hopefully they're not cutting any more. People think they're going to raise with inflation coming, but 50% of GDP, that's how much money has been injected into this market, and coming in at the same time is going to result in more and more buying of stocks and equities. So if you like this video, give me a shout out on YouTube, and as always, I'll report back to you guys soon. Take care.